Hey guys, this is the how to use velocity banking and infinite banking to create a wealth flywheel video. Here we go. What if I told you that everything you've been taught about money is designed to keep you poor? Think about it. You work your entire life, pay taxes on every dollar you earn, and then give what's left to banks who loan your money back to other people at 10% interest while paying you a massive 0.4%. Now here's a number that'll probably blow your mind. The average American will pay around $650,000 in their lifetime in interest alone. That's literally your vacation money, your kid's college fund, your retirement, all flowing directly into bank shareholders' pockets. But here's what's crazy. Wealthy families have been using two specific strategies for decades to completely flip the system on its head. And instead of becoming victims of the banking system, they've learned how to become the banking system. Today, I'm going to show you exactly how to pay off a 30-year mortgage in under 10 years while building a tax-free wealth machine that you control completely. Now, I need to be upfront with you. This is not for everyone. These strategies require discipline. It requires a certain amount of discretionary income, and it requires long-term thinking that most Americans, frankly, don't have. But if you're tired of making banks richer, you're tired of working hard for your money and wondering where it all went, and you're ready to learn how money really works for the wealthy, then this might change everything for you. Let me break it down. Strategy number one, velocity banking. The first strategy is called velocity banking. And when I share this strategy with the uninitiated, it is like showing the caveman fire. Here's the basic idea. Instead of making those tiny monthly payments to your mortgage company for the next 30 years like everyone else, you're going to use something called a home equity line of credit. That's a HELOC, as your checking account to make periodic lump sum principal payments that wipe out years of interest. Now here's why this works. Mortgages are structured to front load all the interest. So in the early years of your mortgage, you're paying about 80 to 90% interest and only 10 to 20% principal, depending on the interest rate. That means that most of your payment is pure profit for the bank during the first 5 to 10 years of repayment. But what if you could skip all that front-loaded interest by making large principal payments right now? That's exactly what velocity banking does. So let me show you with real numbers, because this is where it gets absolutely insane. Let's say you have a $300,000 mortgage at 5% interest. Over 30 years, you'll pay $279,767 in total interest. That's almost as much as your original loan. Now let's say you get a HELOC between $15,000 and $25,000 at 8%. And I know what you're thinking. Wait, 8% is higher than 5%. That doesn't make sense. But here's where it gets interesting. Over the course of the next few months, you'll make massive principal payments on your mortgage. Most will be in the $1,000 to $5,000 range. If you were to make one $5,000 payment from your HELOC to your mortgage in the first year of repayment, that single payment would eliminate about 12 to 14 months of future interest payments. So you just saved over $15,000 in interest with one move. Now, imagine doing this over and over again throughout the year. If you find yourself saying, but the HELOC rate's higher than my mortgage, you're forgetting that the mortgage is amortized over 30 years. And the HELOC is simple interest, meaning the interest you pay on the HELOC is based on the average daily balance. So imagine borrowing $5,000 for a month or two. Even at 8%, your interest cost for 2 months would be around $66. So I don't know about you, but I would gladly pay $66 in interest to borrow $5,000 to save $15,000 in long-term holding costs on my mortgage. Now, here's what I'll tell you. This often takes people a few times hearing the explanation before they truly get it. So if you must, go back and rewatch the past couple of minutes. Strategy number two, infinite banking, or creating your own private wealth reserve. Now, velocity banking gets you out of debt fast, but here's the problem. Once your mortgage is paid off, where do you go from there? Most people just go back to saving in bank accounts, earning basically nothing, or they throw everything in the stock market and pray that it goes up. But what if I told you there's a way to become your own bank, where instead of borrowing money from institutions that charge you interest, you borrow from yourself and you keep all the profits? That's what the term infinite banking is all about. You may have also heard this called bank on yourself. Well, infinite banking or bank on yourself sounds complicated. The concept is actually pretty simple. You're going to use a specially designed whole life insurance policy as your personal banking system. Now, forget everything you think you know about life insurance. This isn't about the death benefit, although it's a nice bonus for someone. This is about turning your policy into a wealth building machine that you control completely. And here's how it works. You overfund a whole life insurance policy way beyond what you need for the death benefit. This creates something called cash value that grows every year, guaranteed, plus dividends. But here's the best part. You can borrow against this cash value for anything you want. Cars, vacations, business investments, real estate, literally anything. And here's what makes this an absolutely incredible tool for growing your wealth. Your money keeps growing at the same rate, even while you've borrowed against it. Think about that for a second. With a regular bank, if you take out $50,000, your $50,000 stops earning interest. But through infinite banking or bank on yourself, an overfunded cash value life insurance policy, you borrow $50,000, but your full cash value keeps earning interest and dividends like you never touched it. The reason for this is you're actually borrowing against the value of your policy, but the loan comes from the company holding your policy. There are very specific companies you want to consider when it comes to building these. And I want you to be aware, there are insurance salespeople out there who will claim to be able to help you with one, but they may not know how to set one up properly for long-term wealth accumulation. So let me show you how this works with real numbers. Let's say you're 35 years old and you start putting $12,000 a year into a properly designed policy. To be very candid, the first few years are rough because a chunk of that goes to fees and the cost of insurance. But by year 7, you've paid $84,000 in premiums and you have about $75,000 in cash value that you can borrow against. So you need a new car, and instead of going to the bank, you take a $50,000 policy loan at 5% interest. Now, your full $75,000 in the policy is still earning about 5.5% to 6% in interest and dividends. That's around $4,500 a year. But your loan is only costing you $2,500 a year in interest. And that would be assuming that you've not made any payments to bring down the principal. Now, let me break down what happens when you use both strategies in tandem and we talk larger numbers across the board. The Wealth Flywheel, combining both strategies. Here's where this gets really powerful. Each of these strategies are impactful on their own, but when you combine them correctly, they create what I call a wealth flywheel. See, velocity banking is amazing for eliminating debt fast, but it's essentially a temporary tool, or at least not something that should only be focused on. Once your mortgage is gone, technically you're done. And infinite banking builds incredible long-term wealth, but it takes years to really get momentum using it. So what if you could use the fast debt elimination from velocity banking to supercharge your infinite banking policy, and then use your growing infinite banking cash value to replace the HELOC entirely? That's when you create a system that feeds on itself and gets more powerful every single year. Here's how it works in 3 phases. Phase 1, years 1 to 2. You use velocity banking to attack your highest interest debt first, freeing up monthly discretionary income. You'll start eliminating the principal balance of your mortgage in big chunks, which creates equity, and focusing on increasing your HELOC limit over the first 12 months or so. In the first year, you're building efficiency with your income and your cash flow, the ultimate goal being to own more of the money you make. Phase 2, years 3 to 5. Now that you have a significant equity in your home and access to a decent chunk through your HELOC, it's time to begin funding your policy. How much you want to fund the policy with is a much more personal question. It's based on a variety of factors like your age and your health, the amount of death benefit you want or need, and what the plan is with the funds you're putting in the policy. My best advice is to reach out and have that conversation with one of our coaches to really dial in the details of your situation and your goals. In phase 3, years 6 and beyond, at this point, your mortgage is likely gone at this point, or you've recasted it and have a stupidly small payment. And you've been funneling premium and paid up additions payments to your policy, so that cash value has grown through the years. Now, depending on how much you've stacked in the policy already, It's high time to put that money to work for you. This is the real power of these policies. Borrowing against the cash value and investing it in cash flow producing assets to further the wealth creation flywheel. Let me show you what this timeline looks like with real numbers. Year one, you eliminate $25,000 in credit cards, car loans, and other debt using Velocity Banking, and you're building serious equity in your home while saving tens of thousands of dollars in lifetime interest. By year three, your mortgage is quickly on its way to being paid off. You've likely recast the mortgage by this point, and you're saving $18,000 a year in the reduced mortgage payments. By year five, cash flow is redirected into your policy. Policy cash value is growing significantly year over year, and you've reached compound interest velocity. That's when you're seeing interest and dividends that actually excite you in that policy itself. By year seven, you use a $100,000 policy loan to buy a rental property that generates $1,200 a month. And by year 10, your policy has $200,000 in cash value, and you're generating $3,000 to $5,000 a month in passive income from the investments you're making every single year. Do you see what's happening? Each step creates more cash flow that feeds the next step. That's the flywheel effect. By year 10, you have complete control over $200,000 plus in liquid wealth, and you're completely independent from the traditional banking system. Who should not do this? Now, this probably sounds too good to be true. So let me be brutally honest about who this works for and who it absolutely doesn't. If you make less than $75,000 a year, or you have a regular income, stop right here. If you have less than $1,000 in positive cash flow every month after all your expenses, and I'm talking about money left over after your mortgage, your car payments, groceries, utilities, everything, this is not for you. If your credit score is under 680, you won't qualify for the HELOC rates that make this work. And if you need results in 1 or 2 years, I would consider looking for another option. This is a 5 to 7 to 10 year minimum commitment. Here's what most gurus won't tell you. Only about 10 to 15% of Americans actually qualify for these strategies. And of those who qualify, many lack the discipline to execute them properly. Now, if any of those situations sound like yours, it's perfectly okay. The shred method can work for you if your discretionary income is in the $200 to $1,000 range per month. What we'll do right off the bat is focus on knocking out increasing your and decreasing your debt load. And then you'll be ready to take full advantage of both strategies. It's a little bit slower start, but we'll get you there. Here's who this is for. If you make well over 6 figures combined income, you and a significant other or you individually. If you already own a home, and especially so if you already have a HELOC in place, this is definitely for you. If you work really hard to make really good money, but you wonder where does it all go, or you're looking for a way to have better control and the ability to create freedom and flexibility long term, this is for you. Getting started. If you're still with me and you meet those qualifications, here's how to get started safely. First, get your financial house in order. I want you to build a 3 to 6 month emergency fund and make sure you have the $1,000 plus monthly surplus locked in. Second, when using the shred method, we'll start with the Velocity Banking component first. You will see rapid results and it will keep you motivated as you get started. So the way to get a HELOC is to get quotes from at least 3 lenders. Credit unions often have the best rates. Just know that you're looking to keep things very simple. So if you already have a relationship with a banking institution and they offer HELOCs, check there first. Third, I want you to find the right professionals. Don't just go with your current financial advisor or your insurance agent just because they say, hey, I can do the same kind of product. Candidly, they may not know how to structure a policy for the way in which you're planning on using it. So for infinite banking, you definitely need a specialist who understands policy design, not just any insurance agent or advisor. And here's my biggest piece of advice. Start small and prove the concept to yourself. Test Velocity Banking for 6 months. If it works for your situation and your discipline level, then consider adding infinite banking to the mix. Using the Shred Method software, it is very easy to modify your habits to get the maximum benefit of the system. Next step. Look, these strategies can absolutely transform your finances, but they require discipline that most people honestly don't have. So if you try this and you realize it's too complex, there is no shame in going back to simple strategies. But if you want a proven system to automate Velocity Banking for you, I highly recommend checking out the Shred Method. It's the exact system we use to help people eliminate debt in record time, to boost their cash flow, and get one step closer to building their own wealth flywheel. It accounts for every single debt, every expense and income source. It analyzes your cash flow and helps you figure out exactly when and how to make those chunked lump sum payments, so you're not guessing or making expensive mistakes. If you want to take the guesswork out of velocity banking and see just how powerful this can be when it's running on autopilot, go check out theshredmethod.com. I've linked it below. Listen, your money deserves to work harder, and with the right system, it absolutely can. Hit subscribe if any of this helped. Share it with a friend if you think someone else might be interested in the content. And remember, you don't need to be rich to build wealth. You just need to stop playing by the bank's rules. We'll see you on the inside.